For years, Stanford Financial promised investors safe, high-yield certificates of deposit. The bank operated offshore in Antigua. It marketed itself as a stable international financial institution. Its products offered returns higher than major United States banks. Investors interpreted the higher yields as evidence of superior investment management. Billions of dollars flowed into Stanford International Bank accounts. Behind the operation was a bank scam built on fabricated investment performance and recycled deposits. Internal reports claimed steady gains across diversified assets. The numbers appeared consistent and the returns kept arriving. Few investors questioned how the profits were generated. In 2009, when large withdrawals began, the financial structure collapsed. The Stanford Financial scam demonstrated how trust can substitute for verification. Stanford International Bank operated under an offshore banking license issued in Antigua. The institution was part of the Stanford Financial Group, controlled by Alan Stanford. The offshore structure allowed the bank to operate outside standard United States banking supervision. The primary product marketed to investors was a certificate of deposit. These certificates promised returns consistently higher than major commercial banks. The target market included investors in the United States and Latin America. Financial advisors promoted the product as a stable international banking instrument. Marketing materials emphasized security and conservative investment management. The bank claimed that investor funds were allocated into diversified global assets. These assets allegedly included equities, bonds, and private investments. Promotional documents suggested disciplined risk management. Investors were told that the bank maintained strict internal oversight. The Antigua jurisdiction provided regulatory authority for the institution. However, oversight standards differed significantly from United States banking regulation. This structure allowed Stanford International Bank to accept foreign deposits with limited transparency. Investors often interacted with advisors located in the United States. Deposits were then transferred to accounts held in Antigua. The offshore location created distance between investors and the underlying institution. Most depositors never visited the bank's headquarters. Instead, they relied on account statements and marketing reports. Financial statements reported consistent annual returns. These returns often ranged between 7 and 10%. The yields appeared attractive but not immediately suspicious. Investors compared them with lower yields offered by U.S. banks. The difference reinforced the belief that the bank possessed superior investment capability. Advisors frequently described the certificates as safer than stock market investments. The messaging emphasized stability rather than speculation. Many investors treated the certificates as a fixed income savings product. Retirees and conservative investors formed the large portion of the client base. The institution cultivated an image of disciplined wealth management. Corporate branding reinforced the appearance of a global financial group. Stanford Financial maintained offices in several countries. Employees operated advisory branches across the United States. The structure gave the impression of a multinational financial network. Depositors believed they were dealing with a legitimate international bank. The Antigua license appeared to validate that perception. Few investors examined the regulatory limits of the offshore jurisdiction. Most relied on the credibility of the brand and advisors. The cross-border structure complicated oversight responsibilities. U.S. regulators had limited direct authority over the Antigua Bank. Local Antiguan regulators possessed formal supervisory responsibility. This divided oversight created gaps in scrutiny. These gaps allowed the institution to market high-yield deposits widely. The offshore framework enabled large capital inflows with limited verification. The institutional structure appeared legitimate on the surface. Investors interpreted the structure as evidence of international sophistication. In reality, the jurisdictional arrangement reduced effective monitoring. The bank's credibility relied heavily on marketing and trust. Jurisdiction defines scrutiny. The core attraction of Stanford International Bank was the promise of high-yield certificates of deposit. These certificates offered interest rates significantly above those of traditional banks. During the early 2000s, many U.S. banks paid interest rates between 2 and 4%. Stanford certificates often advertised annual returns between 7 and 10%. The difference attracted investors searching for stable income. Marketing materials emphasized that the higher yield resulted from superior investment allocation. Advisors explained that the bank used a diversified global portfolio. This portfolio allegedly included government bonds, equities, and private investments. The strategy was described as conservative but internationally diversified. Investors were told the bank maintained strict internal investment controls. The promotional narrative suggested that disciplined management generated consistent profits. Quarterly statements reinforced this message. Reported returns appeared stable across changing market conditions. Even during periods of stock market volatility, performance appeared unaffected. Investors interpreted the stability as evidence of professional portfolio management. The bank also emphasized capital preservation. Marketing brochures described the certificates as safer than many market-based investments. Advisors compared the product to traditional bank deposits. This framing encouraged investors to treat the certificates as secure savings instruments. Clients often reinvested their returns instead of withdrawing them. The compounding effect increased total deposits held by the institution. High yields encouraged existing investors to add additional funds. Word-of-mouth referrals brought new clients into the program. Financial advisors played a central role in expanding the investor base. Many advisors received commissions for placing deposits. This incentive structure encouraged aggressive promotion of the certificates. Investors rarely received detailed information about the underlying assets. Portfolio reports contained broad descriptions rather than verifiable holdings. Few investors attempted to verify the investment strategy independently. The consistent interest payments reinforced confidence in the system. As long as payments continued, the strategy appeared credible. Higher yields became the central selling point of the bank. Investors focused on the returns rather than the transparency of the operation. The difference between promised returns and market rates required explanation. However, most investors accepted the narrative provided by advisors. The appearance of steady performance reduced skepticism. The bank continued reporting stable annual gains throughout the early 2000s. These gains appeared insulated from global market volatility. Investors interpreted this as evidence of exceptional management skill. In reality, the consistency masked the absence of transparent investment records. Without independent verification, reported returns relied entirely on internal reporting. Clients trusted the institution's statements. The higher yields continued attracting deposits year after year. The promise of superior returns sustained the expansion of the program. Above-market returns require explanation. Stanford Financial invested heavily in constructing a credible public image. The organization presented itself as a respected international financial institution. Corporate offices displayed polished branding and professional marketing materials. Alan Stanford positioned himself as a successful global financier. The company sponsored major sporting events to increase visibility. Cricket tournaments in the Caribbean carried the Stanford brand. The sponsorship agreements generated significant international media attention. These events associated the bank with prestige and global commerce. The organization also supported community initiatives and charitable programs. Public donations created the appearance of social responsibility. Local communities in Antigua benefited from visible philanthropic projects. University programs and public events received financial contributions. These activities reinforced the reputation of Alan Stanford as a prominent businessman. Investors interpreted the public profile as evidence of legitimacy. The organization also cultivated relationships with financial advisors. Advisory offices operated across the United States and Latin America. These offices presented the certificates of deposit as premium financial products. Professional attire and corporate environments reinforced the image of institutional credibility. Clients met advisors in conventional financial office settings. This experience resembled traditional banking relationships. Investors rarely interacted directly with the offshore bank. Instead, they relied on the representation of the advisory network. The Stanford brand appeared consistently across marketing materials. Logos, brochures, and statements projected stability and professionalism. Corporate communications emphasized decades of financial expertise. The organization described itself as an experienced wealth management group. Press coverage often repeated these claims without detailed scrutiny. High-profile events strengthened the perception of legitimacy. Public appearances by Alan Stanford reinforced the image of success. He frequently appeared at sponsored events and financial conferences. Investors associated his public presence with financial authority. The combination of sponsorships and philanthropy created institutional visibility. Brand recognition expanded across multiple regions. Clients interpreted the widespread branding as proof of scale. Few questioned the underlying financial structure. The reputation of the organization shielded the operation from skepticism. Professional branding created psychological reassurance for investors. Trust became a substitute for independent verification. Clients focused on the reputation rather than the mechanics of the bank. Advisors reinforced the narrative of stability and professionalism. The organization continued expanding its investor base during the mid-2000s. Brand credibility became a central pillar of the operation. Reputation shields scrutiny. Stanford International Bank claimed to operate a sophisticated investment strategy. Investor funds were said to be allocated across diversified global assets. Marketing documents described portfolios containing equities, bonds, and private investments. The bank reported that professional managers monitored these assets continuously. Performance reports presented consistent annual gains. These gains appeared stable across changing market conditions. Investors received periodic account statements summarizing portfolio results. The statements showed steady interest payments and increasing balances. However, the bank did not provide detailed disclosure of individual holdings. Independent verification of the investment portfolio was limited. External auditors relied primarily on information provided by the institution. Few investors requested direct evidence of the underlying assets. The bank explained that confidentiality protected its investment strategies. This explanation discouraged deeper scrutiny from most clients. Internally, the performance figures were created within the organization itself. Returns reported to investors did not originate from verified investment results. Instead, they were generated through internal accounting adjustments. These adjustments allowed the institution to report steady gains every year. The consistency of returns reinforced investor confidence. Financial advisors continued promoting the certificates as reliable products. New deposits continued flowing into the bank. The absence of transparent reporting remained largely unnoticed by clients. Investors focused on the regular interest payments they received. Statements showed predictable increases in account balances. The internal reporting process became central to maintaining credibility. Without transparency, investors depended entirely on the bank's representations. The institution controlled both the reporting and interpretation of results. External scrutiny remained minimal during the early 2000s. The offshore location complicated access to detailed financial records. Regulators outside Antigua possessed limited authority to inspect operations. Within the organization, fabricated performance figures sustained the narrative of success. Each reporting cycle reinforced the appearance of profitability. Investors interpreted these reports as confirmation of effective investment management. Few questioned why the returns appeared immune to market volatility. The institution maintained that its diversified strategy reduced risk. This explanation satisfied most depositors. The cycle of reporting and trust continued for several years. The lack of transparency prevented investors from assessing actual risk exposure. Financial statements became the primary source of perceived credibility. Behind the reports, no verifiable portfolio produced the stated returns. The operation relied on internally generated performance data. Investors accepted the narrative presented in official statements. Without transparency, the reported strategy remained a narrative rather than a verifiable system. Performance without transparency is narrative. Behind the reported investment strategy, Stanford International Bank depended on a continuous inflow of new deposits. Investor funds entered the bank through certificates of deposit marketed by financial advisors. These deposits were transferred to accounts controlled by the institution in Antigua. Instead of funding a diversified investment portfolio, large portions of the deposits remained within internal accounts. The bank used incoming funds to maintain the appearance of regular interest payments. Interest credited to existing investors often originated from newly received deposits. This structure created a cycle of deposit recycling. As long as new investors entered the program, the payment system remained functional. Quarterly interest statements reassured existing clients. These statements reported steady returns credited to their accounts. Many investors reinvested their interest instead of withdrawing it. Reinvestment increased the total deposits recorded by the institution. This process extended the lifespan of the system. Financial advisors continued promoting the certificates to new clients. Each new deposit increased the available cash flow. The bank used part of this flow to satisfy withdrawal requests. Another portion funded interest payments reported on account statements. The structure depended heavily on continuous investor participation. If deposit growth slowed, the bank's ability to maintain payments weakened. The system therefore required a constant expansion of the investor base. Marketing campaigns encouraged new clients to join the program. Advisors emphasized the reliability of past performance. Clients interpreted historical returns as evidence of stability. In reality, the structure lacked independent investment income. Cash entering the system became the primary source of liquidity. This liquidity supported both interest credits and withdrawals. Internal accounting allowed the bank to report stable balances. Investors rarely saw the underlying cash flow mechanics. Statements showed orderly financial growth. Behind the reporting system, cash moved between accounts to maintain appearances. The institution managed these movements internally. External investors remained unaware of the recycling process. Confidence in the certificates sustained continued deposits. As long as trust remained intact, the system functioned. However, the structure possessed inherent fragility. Large withdrawal demands could disrupt the flow of funds. Without new deposits, liquidity would decline rapidly. The bank relied on continued investor confidence to maintain operations. This dependency represented the core vulnerability of the structure. The stability of the system depended on uninterrupted cash flows. Deposit recycling allowed the illusion of consistent performance. Cash flow dependency defines fragility. Questions about Stanford Financial began appearing years before the final collapse. Regulators received early complaints regarding the bank's unusually stable returns. Some analysts questioned how the institution consistently outperformed market benchmarks. The United States Securities and Exchange Commission began examining the operation in the early 2000s. However, the structure of the organization complicated oversight. Stanford International Bank operated under Antiguan banking authority. The investment advisors selling the certificates operated largely in the United States. This separation created jurisdictional challenges for regulators. The SEC had authority over the advisors, but limited authority over the offshore bank. Investigators needed cooperation from foreign regulators to access internal banking records. The Antiguan regulatory framework operated with fewer investigative resources. Communication between agencies progressed slowly. Regulatory inquiries, therefore, moved gradually. Meanwhile, the bank continued marketing its certificates to investors. Deposits continued increasing throughout the mid-2000s. Advisors reassured clients that the bank complied with international banking standards. Public confidence remained largely intact. Internal bank operations faced little immediate disruption. Regulatory warnings, therefore, produced limited external impact. Some analysts published reports questioning the bank's performance. One such report appeared in 2006, raising concerns about transparency. The report argued that the returns appeared unusually consistent. It suggested that the portfolio lacked verifiable disclosure. Despite these warnings, many investors remained confident. The institution dismissed the criticisms as misunderstandings. Advisors repeated this explanation to their clients. Investors continued receiving regular interest payments. The continued payments reinforced belief in the system. Regulators attempted to expand their investigation. However, the offshore jurisdiction limited direct access to financial records. Legal procedures required additional time to obtain documentation. During this period, the bank continued operating normally. The institution maintained its public image and marketing campaigns. Investor deposits continued flowing into Antigua. The delay between warning signals and enforcement action grew longer. This delay allowed the financial structure to continue expanding. The regulatory environment remained fragmented across jurisdictions. Multiple agencies possessed partial responsibility but limited coordination. The offshore framework reduced the speed of enforcement. Investors remained largely unaware of regulatory concerns. Public confidence, therefore, remained stable. The structural weaknesses of oversight became increasingly visible. Fragmented oversight enables continuity. The global financial environment changed significantly during 2008. Credit markets tightened following the collapse of major financial institutions. Investor confidence declined across many sectors of the financial system. Banks and investment funds faced increasing liquidity pressure. The financial crisis increased attention on financial stability. Investors began reviewing the safety of their assets. Some Stanford Financial clients considered withdrawing funds. Questions about liquidity began circulating among advisors and clients. The certificates of deposit had previously been treated as long-term investments. During the financial crisis, liquidity became more important to investors. Withdrawal requests therefore began increasing. The bank needed sufficient cash to satisfy these requests. However, the internal structure depended heavily on continuous deposit inflows. The financial crisis reduced the pace of new investments. Market uncertainty caused some investors to delay new deposits. At the same time, more clients sought to redeem their certificates. This combination placed pressure on the bank's available liquidity. Cash inflows slowed, while outflows increased. The deposit recycling structure began experiencing stress. Advisors attempted to reassure investors about the bank's stability. Communications emphasized the long history of consistent returns. However, some investors remained cautious. The financial crisis increased skepticism toward financial institutions. Clients began asking additional questions about investment strategy. Advisors often repeated the bank's official explanations. The institution maintained that its portfolio remained stable. Internal reports continued showing consistent returns. These reports attempted to preserve investor confidence. Despite these assurances, withdrawal pressure continued rising. The structure relied on maintaining the perception of stability. As more investors requested redemptions, the liquidity balance weakened. The institution needed additional deposits to maintain normal operations. However, new investment activity declined during the crisis. Market conditions therefore exposed the bank's structural dependency. Cash flow imbalance became increasingly visible internally. The institution struggled to maintain normal payment schedules. Advisors attempted to slow withdrawals through reassurance. Some clients delayed redemption requests after receiving explanations. Others continued requesting access to their funds. Each additional withdrawal increased pressure on the system. The financial crisis therefore acted as an external stress event. The structure could operate under stable conditions, but struggled during liquidity pressure. The underlying mechanics became more difficult to sustain. Stress exposes structure. By early 2009, the financial structure supporting Stanford International Bank had become unstable. Withdrawal requests continued increasing across the investor base. The institution struggled to maintain normal liquidity levels. New deposits no longer offset the rising demand for redemptions. Internal cash balances became insufficient to sustain the payment cycle. At the same time, regulatory scrutiny intensified. The United States Securities and Exchange Commission expanded its investigation. Investigators sought detailed records of the bank's investment portfolio. Requests included documentation of asset holdings and transaction history. The institution could not produce verifiable evidence supporting the reported returns. Financial statements lacked independent confirmation of the portfolio. In February 2009, the SEC filed civil fraud charges against Allen Stanford and several associates. The agency alleged that the certificates of deposit were part of a large investment fraud. Authorities moved to prevent further transfers of investor funds. A federal court approved the appointment of a receiver to oversee the companies. The receiver gained authority over Stanford Financial Group operations. Assets connected to the institution were frozen during the investigation. Offices associated with the organization faced immediate disruption. Employees lost operational control over financial accounts. Investors learned that withdrawals would be suspended. Public announcements confirmed that regulators had intervened. The structure that had operated for years stopped functioning within days. Financial records were transferred to court-appointed administrators. Investigators began examining internal accounting documents. Early reviews revealed inconsistencies in reported investment activity. Large portions of the claimed portfolio could not be identified. Statements provided to investors did not correspond with actual holdings. The bank lacked sufficient assets to cover the outstanding certificates of deposit. Estimated investor exposure exceeded $7 billion. The discovery confirmed that the reported investment strategy had not existed as described. Legal proceedings began to determine the full scale of the losses. The collapse ended the institution's ability to operate as a bank. Investors could no longer access their deposits. Advisory offices closed across multiple countries. Employees and advisors faced uncertainty regarding their roles. Financial regulators coordinated investigations across jurisdictions. The collapse attracted international media coverage. Government agencies began pursuing recovery of remaining assets. Courts initiated bankruptcy and receivership proceedings. Legal processes aimed to preserve whatever funds remained. The investigation continued expanding throughout 2009. Authorities focused on tracing the movement of investor deposits. The collapse demonstrated how quickly confidence can disappear. For years, the system depended entirely on investor trust. Once regulatory action exposed the structure, trust evaporated immediately. Confidence evaporates instantly. After the collapse in 2009, legal proceedings began against Allen Stanford and senior executives. Federal investigators gathered financial records from Stanford Financial Group offices. Authorities analyzed bank transfers, internal accounting documents, and investor communications. The investigation focused on the sale of certificates of deposit issued by Stanford International Bank. Regulators alleged that the institution had misrepresented how investor funds were invested. According to prosecutors, large portions of the deposits had not been invested as claimed. Instead, the funds had supported interest payments, operating expenses, and executive spending. The legal case developed over several years as investigators reviewed financial evidence. Alan Stanford was arrested in June 2009 in Virginia. Federal prosecutors charged him with multiple counts of fraud and conspiracy. The charges included securities fraud, wire fraud, and obstruction of regulatory investigations. Court proceedings required extensive documentation of financial transactions. Investigators traced billions of dollars in investor deposits moving through Stanford-controlled accounts. Some funds had financed corporate sponsorships and real estate acquisitions. Other transfers supported personal expenditures associated with the organization's leadership. The legal process aimed to determine responsibility for the financial deception. Witness testimony included former employees and financial advisors. Documents presented in court demonstrated discrepancies between reported investments and actual holdings. Prosecutors argued that the bank's portfolio claims were largely fabricated. Defense attorneys challenged elements of the investigation and the interpretation of records. The trial proceeded in federal court in Houston, Texas. Evidence included investor statements, promotional materials, and internal correspondence. Jurors examined years of financial reporting distributed to depositors. The prosecution argued that the certificates of deposit had been marketed using misleading information. In March 2012, a federal jury found Alan Stanford guilty on multiple criminal charges. The verdict confirmed that the investment program had misrepresented the use of investor funds. Later in 2012, the court issued a sentence of 110 years in federal prison. The sentence reflected the scale of the financial losses experienced by investors. Additional legal proceedings addressed the roles of other executives. Some associates faced criminal convictions or regulatory penalties. Civil lawsuits also targeted financial advisors involved in selling the certificates. Regulators sought to recover assets connected to the operation. Court-appointed receivers continued tracing the movement of investor funds. Asset recovery included real estate, financial accounts, and corporate holdings. Recovered assets formed part of a restitution process for investors. However, the total recovered funds represented only a portion of the losses. Legal proceedings continued for years after the original collapse. Cross-border financial transactions complicated the recovery process. Multiple jurisdictions participated in asset tracing efforts. The court system became the primary venue for resolving the consequences of the scheme. Fraud ends in court. After the collapse of Stanford Financial in 2009, thousands of investors faced significant financial losses. Many depositors had treated the certificates of deposit as secure savings instruments. A large portion of the investor base consisted of retirees seeking stable income. When withdrawals were suspended, investors could no longer access their deposits. Account balances shown on previous statements did not correspond to available assets. Court-appointed receivers began assessing the total financial damage. Initial estimates placed investor exposure above $7 billion. The recovery process required identifying and securing remaining assets. These assets included bank accounts, real estate holdings, and corporate property. Receivership teams examined financial records to trace the movement of funds. Some assets were located within the United States. Others were connected to international holdings linked to Stanford Financial operations. Cross-border ownership structures complicated asset identification. Legal authority differed across jurisdictions involved in the investigation. Asset recovery, therefore, required coordination between multiple courts. Investors often waited years for partial restitution. Many depositors discovered that their retirement savings had been heavily concentrated in the certificates. Financial advisors had previously described the investment as conservative. The sudden loss created financial uncertainty for many households. Receivership administrators attempted to distribute recovered assets proportionally. However, the recovered funds represented only a fraction of the reported deposits. Legal costs and administrative expenses also affected the final distributions. Court proceedings addressed disputes among creditors and investors. Some investors pursued additional civil lawsuits against advisors. These lawsuits alleged that advisors failed to identify warning signs. Other legal claims focused on regulatory responsibility. However, the complexity of the case limited immediate compensation. International financial transfers slowed the tracing of remaining funds. Receivership teams continued investigating asset locations for years. Recovered assets gradually increased the pool available for restitution. Distribution payments occurred periodically as assets were secured. Despite these efforts, many investors recovered only partial amounts. The financial damage extended across several countries. Investors in the United States, Latin America, and the Caribbean were affected. The case illustrated the long-term consequences of financial fraud. Recovery processes often extend far beyond the initial collapse. Legal structures prioritize verification and asset tracing before distribution. Investors must wait until courts authorize payments. Complex financial structures slow the recovery timeline. Offshore jurisdictions introduce additional legal layers. The restitution process, therefore, becomes extended and uncertain. Investors eventually receive partial distributions after prolonged legal procedures. Complexity delays restitution. The Stanford Financial case illustrates the structural pattern common in many offshore banking scams. The operation began with the creation of an international banking structure. Stanford International Bank held a license issued in Antigua. This jurisdiction allowed the bank to operate outside direct United States banking supervision. Financial advisors located in the United States promoted the bank's products to investors. The primary product offered was a certificate of deposit promising stable returns. These returns were consistently higher than those offered by traditional banks. The yield difference attracted investors searching for reliable income. Marketing materials emphasized stability and conservative investment management. Investors interpreted the higher returns as evidence of superior financial strategy. Public sponsorships and philanthropy reinforced the credibility of the institution. The Stanford brand appeared widely across sporting and community events. This visibility strengthened investor confidence in the organization. The institution reported consistent performance through internal financial statements. These statements claimed diversified global investment portfolios. However, the underlying assets lacked independent verification. The absence of transparency remained largely unnoticed by investors. New deposits continued flowing into the institution each year. Incoming funds supported interest payments credited to earlier investors. This cycle created a dependency on continuous investor participation. As long as new deposits entered the system, the structure remained stable. Regulatory oversight remained divided across multiple jurisdictions. United States regulators oversaw the advisors, but not the offshore bank. Antiguan authorities supervised the banking license. The separation reduced the speed of regulatory intervention. Warning signals, therefore, accumulated slowly over several years. The global financial crisis in 2008 introduced external liquidity pressure. Investors began requesting withdrawals from their certificates. Deposit inflows declined during the same period. The structure could not sustain both interest payments and rising withdrawals. Regulatory investigations accelerated during this period of financial stress. Authorities requested documentation of the bank's investment portfolio. The institution could not provide verifiable evidence supporting its reported returns. Legal action followed in early 2009. Asset freezes and receivership proceedings halted the bank's operations. Investors learned that the reported investment strategy had not existed. The collapse revealed the underlying dependency on investor deposits. Subsequent legal proceedings confirmed the scale of the deception. Alan Stanford was convicted in federal court in 2012. The case demonstrated how offshore structures can obscure financial activity. Marketing credibility can substitute for verification when oversight is limited. High-yield promises attract deposits in the absence of transparency. Deposit recycling can sustain the illusion of consistent performance. Liquidity stress eventually exposes the structure. When oversight is divided, fraud finds space.